Good morning, welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's check what we saw overnight then. And we did see tech and semiconductor stocks dragging the broader market lower on Wall Street. The S&P 500 and NASDAQ finishing in the red there. The Dow managing to eke out a gain. Investors positioning ahead of Nvidia's earnings and Fed Chair Kevin Warsh's Jackson Hole speech at the end of the week, with geopolitical tensions around Iran sanctions adding to that backdrop. So in terms of tech stocks, was led by declines in the chip makers. Among the largest movers there, Nvidia down almost 3%, Micron, Broadcom also under pressure. That comes as there's political pressure on AI data centers, which has added to that sentiment risk. And global chip weakness emerged after Samsung's shareholder return plan disappointed investors. Memory chip stock SanDisk fell heavily, while Intel was hit by semiconductor rotation and chip profit sustainability concerns. And Marvell Technology fell alongside broader networking and AI hardware names. Elsewhere, Alibaba's discounted $10.2 billion share sale also weighed on tech. Well, US Treasury Secretary Scott Bessent has threatened economic punishment against any country doing business with Iran as part of what he called an economic D-Day campaign to isolate the country and end nearly 6 months of war. He said, "We are launching an economic onslaught against Iran's financial connections around the globe." Meanwhile, the Treasury Secretary refrained from any further signals on revamping US debt management following a report that his department could draw down some of its cash pile to fund buybacks of high-yielding older securities. Well, the US two-year Treasury yield ranging between 4.22 and 4.25%, the 10-year fell to 4.7%. The Australian three-year government bond yield futures ranging between 4.53 and 4.55. The 10-year at around 5.02%. The US dollar index was up around 1/5%. The Aussie is lower at 71.5 US cents. Well, energy prices fell amid mixed messages over supply disruptions out of the Middle East. Brent crude futures down from $94 to $92 a barrel. Gold rose almost 1% to another fresh 3-month high. Copper futures little changed. Iron ore up almost 2% to $99 a tonne. And Bitcoin, that continues its ascent, now just shy of 79,000 US dollars. Let's get across those market moves and more. We are joined by Interactive Brokers Chief Market Strategist Steve Sosnick. Steve, welcome back to you. Let's start with what we're hearing from Scott Bessent. He's a busy man at the moment. Obviously, he's looking at the Middle East, as I mentioned there, just as far as threatening punitive action against any country that deals with Iran. And we also saw last week, at least, that intervention in the Treasury market. Let's start with that. What's the effect of that been? It's said to be short-lived.
Yeah, good morning, Andrew. It was short-lived, and it's interesting because in many ways, Bessent should know better. Part of his reputation is that he was on George Soros's team during the episode where Soros famously basically broke the pound or broke the Bank of England. There's been some social media implying that he wasn't as important as he portrays, but I have no reason to doubt his biography. So let me just say that, if he was part of this team, he would know that ultimately you can't, if you're a central bank or you're, a governmental or institution, you can only fight the prevailing tides, to a certain extent without something really changing. If the markets really want something, the markets tend to be bigger no matter who you are. And we saw this with the yen intervention a couple of weeks ago, where the effects were short-lived, and I think a lot of traders saw an opportunity to short the yen, because again, how is intervention going to help unless the BOJ or the Japanese government does something to sort of fix their fiscal house? Same thing here with the long end of the curve, long end of the Treasury curve. A few $billion here and there is signaling, but it's not going to change the fundamental nature of the curve, and that is powered by, number one, inflation fears, and number two, a huge demand for paper from U.S. and global corporations, many of whom are borrowing in dollars, even if they're not U.S. based. But if you're looking at the prospect of a U.S. government that needs to borrow trillions of dollars and private businesses that need to borrow potentially, several billion, if not trillions of dollars, that's going to have pressure on long-term rates. Some people are saying, is this, what part of fear of government insolvency or things of that nature? I don't go that far. Credit default swaps are not signaling panic. It's not like a Greece-like situation like we saw in 2010 or some of the runs on Italy during that decade. This is much more, I think, just supply and demand, but you're seeing real interest rates hover around 3% at the long end of the curve, and that can't be very comfortable for an administration that has professed a desire to see lower rates and to make housing more affordable uh, amidst this backdrop.
Do you, what's the likelihood, Steve? Do you think the market's going to push back, particularly at the long end?
I think that they'll wait a little bit because it turns out that because there's the Treasury General account, there is some money that he can use. It was believed that they only had a few $1 billion at their disposal, so there's a bit more in there. So I think you're going to look at a little more stasis, barring some major change, whether that's a changed commitment from Warsh about fighting inflation, whether that's and I can't imagine what there would be on the fiscal side, but something else on an actual fiscal plan. Um, but barring that, I think they've got a little more ammunition. It was revealed today than people thought they did. But ultimately, the tide is flowing out. And maybe I'm using a lot of tidal analogies. My vacation was partly in the Bay of Fundy, where they have 13-meter tides, and I was kayaking in them. So I'm very conscious of this right now. But if you're battling the tides, you have to paddle very, very hard. It's very easy if the tide's moving in your direction. You just have to steer. But he's battling some very, very big forces here. And ultimately, the markets are going to prevail unless something underlying the surface changes the underlying momentum.
Steve, you just mentioned you had a recent vacation to the north in Canada. I dare say anyone you met there, you say you come in peace because given what's going on diplomatically and on the trade front, of course, that relationship very much fraught between the US and Canada. Given what's going on with tariffs at the moment, what's the likely effect of this?
Probably nothing good. I mean, one of the things that's an unlikely effect is, one of the government's goals is to sort of make housing more affordable, but you've just added big tariffs onto the preferred type of wood that's used for framing a house, which comes from Canada, so that can't be good. And bottom line is, I think Mark Carney is a smart man. He's going to take his time. And, the Canadians are going to come up with stuff that's going to be targeted but painful. Obviously, the U.S. economy is bigger, and while Canada is our biggest trading partner, we are a bigger trading partner of Canada's. But we get, things like energy and raw materials, all of which we need right now. And also, they can kind of target their activities toward swing states to sort of punish candidates that may be a little too aligned with the administration and subtly favor candidates that are not through any overt activity, but look, I live in New England, Connecticut, and we get a lot of our energy from Canada. If they put export duties on Canadian energy, my energy prices are going to go up. Probably won't affect, it's not going to necessarily change the votes of people in Connecticut, in Massachusetts, stuff like that. But Maine, where you have a very heavily contested senatorial election, which borders Canada and trades with them immensely, that this may swing the Senate race in a subtle way. So there's a lot of moving parts. They're taking their time and being very strategic, and they are angry. I mean, I can't overstate this from having spent a week up there and listening to radio and just talking to people. They're angry.
Well, we can understand that. Steve, just before we go, a couple of key events, of course, later this week in Nvidia's results and also the Jackson Hole Symposium. Are they potentially market-moving events, I guess, particularly with Nvidia?
Both of them have been known to move markets. So let me state this. I mean, I say this every quarter. that Nvidia is arguably the most important set of earnings that we get. But I can't really refute myself on that one because it is such a large company, and effectively they are at the nexus of the whole AI trade at this point. In some ways, you could think of them as the banker to the AI trade because of all this, all the side deals, some would say circular deals, that they have with other AI providers or other AI vendors or things of that nature, whether it's customers or suppliers to Nvidia, customers of or suppliers to Nvidia. So they need to show that there's forward progress. They need to show that there's good guidance. And also, you have to give people a reason if you're going to get fresh money in, because I can't imagine there are many institutions or individuals at this point who don't have a that don't have an opinion on Nvidia and are saying, oh, you know what, let me just wait and see how things turn out. So I think it's risky on a more one-tailed side because we have seen a lack of response even when the numbers have been very good, because I think there isn't this need for follow-through buying. As for Jackson Hole on Friday, a lot of times these conferences go without a hitch, but a few years ago, we remember Jerome Powell, 2022, I think it was, basically came out and said, you think I'm cutting rates? You think I'm not fighting inflation? No, I'm gonna stay the course. The market hated that. I don't think that Warsh is going to give a very long speech. He certainly doesn't seem like the type. But it'll be interesting to see how strident he is, about his continued fight on inflation and whether he feels there's progress. And also, I think while it would be very useful to learn about whether he thinks that Bessent's actions are sort of a form of quantitative easing. When the Fed did it, it was called the Operation Twist. But I highly doubt that Warsh is going to address that question, even though it's probably top of mind for Fed watchers right now.
Well, look forward to unpacking it this time next week. Steve, enjoy the week. Thanks for joining us on Interactive Brokers.
Thanks, Andrew. Take care.
Turning our attention to the local market ahead of the open then, we are expecting a modestly higher beginning there, up more than 0.1%. That's according to SPI Futures. And of course, key results to get across, including the likes of Coles and Woodside. And we'll do that at the open. Join us for that.